I went live a little early. Premature live vacation. Hey, it's Soleil, and this is episode 388 of the Orange Pill Investor. Step away from the ledge. This was always in the cards. And, if I had a crystal ball and I knew exactly what was going to happen, I could have just, went straight to cash and sold everything and bought back the dip or whatever. But since I don't, I basically take both positions. I'm long and short at the same time. My shorts have short-term um, expirations with that are aimed to generate and collect theta. My longs have long-term expirations, either long calls that are leaps or straight up shares that have no expiration date. Um, but before I get into making a few trades, I will go over the title of the video is this channel good for Bitcoin? So of course I'm biased. I had enough ego to call it the Orange Pill Investor, which is basically just jumping to the default that I am orange pilled. But I've been listening to a lot of Jeff Booth again recently. I had pretty much listened to everything that I could find at one point, and I guess I stopped looking because it was just hard to find anything. But either he's been making the rounds again, or he's been doing podcasts the whole time, and I just wasn't listening because I wasn't looking. And when you stop looking, the algorithm stops delivering those things to you. But one of the things that he talks about is trying to extract your time and energy and really your brain and your thought process from the extractive fiat system and try to live in the new Bitcoin system that in a sense already exists because it's inevitable. We're just waiting for the future to become fully realized. And so, one of the things that I've learned to be pretty decent at is selling options over the last 5 years. And so that naturally tends to be something that I enjoy. So it's something that I talk about. But is it good for Bitcoin? Is it good for Bitcoin adoption? Is it good for transitioning from the control system to the, basically the freedom system? And so I'm trying to give an honest look at that. And so if I try to boil this down to first principles, and I'm going to try to really drill down into it, because a lot of people will just be like, you got to look at this from first principles, and then they literally just don't fucking look at it from first principles at all. So can any channel that talks about stocks be good for Bitcoin? Because the stock market was created before the Bitcoin started imposing the free market on the world. But there are a lot of things that existed before Bitcoin that are going to exist forever. And one of those things is going to be companies, right? There's going to be companies that are built on a Bitcoin standard, and those companies will be valued at their Bitcoin holdings, plus however, whatever products and services they can provide that upgrade the world. So anything that's worth another person trading their sats for a service. And it could be anything from, full self-driving Teslas to the Optimus robots to help you do your laundry and mow the grass. I will definitely be subscribing to the lawnmower app for my Optimus robot, because I cannot stand that shit. I'm going to have that fucker out there raking leaves and mowing the grass. And while I walk the dogs. So win-win for me. So companies will continue to exist. So the stock market, which allows people to invest in companies that they believe in, will continue to exist even after Bitcoin is, after we get hyper Bitcoinization. So I really don't have a problem with companies, private or publicly traded. And then I've kind of honed in on not just the stock market, but options as derivatives. And in one sense, when someone buys an option and someone sells it, or when someone buys a stock or sells it, there's generally a winner or a loser. But that's not necessarily inherently bad, because even in the future, when someone invests in, let's say there's two companies and they're both trying to come up with a cure for cancer, and two different people invest their sats in those companies, if one of them beats the other one or comes out with a product that cures more cancers or cures them better with less side effects, people are going to gravitate towards the better product. And everybody who invested in the second company that fails is going to lose all their Bitcoin. And that's really fine. That's what's supposed to happen. What's not supposed to happen is that companies get too big to fail and then the government has to bail them out, which translation for when government bails anyone out is government steals from its citizens to make those companies whole and make sure that their cronies continue to get richer off the population. So investing and having potentially losing money doesn't really bother me either. That's just kind of how the free market works. So that's kind of working as intended. But I almost kind of think about selling covered calls and cash secured puts as something. Well, one of the use cases for sure would be somebody who's already stacked sats their whole life and they're ready to retire. And it's like, okay, now what? Like, I'm ready to let the next generation earn their sats. So I'm willing to lose my shares of, let's say, Strategy, for example. I'm willing to sell a covered call against my shares. And if, to collect a yield, and if some of them get called away, that's basically just kind of fine, right? Because maybe I got 20 or 30 years of life left, and I really only need to, generate some cash to live on until I keel over and die. And then, the 20 somethings can take over the reins from there, right? They can hodl for the next 50 years, or take a risk on buying some long calls that may or may not appreciate because they're 25 years old, able-bodied. They got freaking nothing but energy to work 40, 50, 60-hour weeks, and they've got 5 decades to stack sats and accumulate wealth. So I don't know if I'm just trying to find an excuse why the content of my channel is good for Bitcoin, or if am I just playing around in the options market, and I'm somehow like endorsing or strengthening the fiat system instead of just exiting completely and going 100% Bitcoin. I think I'm okay with it, but listening to Jeff Booth makes me a little bit reflective and kind of paranoid that I still kind of have the fiat mind virus rattling around in my brain, and I really envy people that are like Mason and Dan's age, who for at least all of their adult lives, like, Bitcoin has existed. But the people that were born like after, even younger than them, people born after, when was Bitcoin invented? But anyway, people that are born in the last 5-10 years, they will never have lived a day in their lives without an honest ledger that exists, that's repricing the world and giving everyone a clear view on the value of things. Because it's like Bitcoin doesn't actually go up in price. Bitcoin is just Bitcoin, and everything goes down in price relative to Bitcoin. So I'm going to give myself a free pass for now. I'm going to keep producing this content as long as as long as people are willing to watch it, and as long as it seems to be a productive endeavor. But if I can turn this into a decent amount of profit, I would like to expand into some other, I guess, smaller businesses, and of course they would, they'd be Bitcoin, based on Bitcoin. I wouldn't be stacking cash with any of those businesses. It would just be straight into Bitcoin. And I've got several ideas that I am personally interested in. So keeping an eye, I'm keeping one eye on whether this channel's content is continuing to deliver value, and keeping another eye on maybe expanding into some other areas. Maybe someone can invent a fucking anti-spam app that actually freaking works. All right. Yeah, let's check the comments. Let's check the chats, and then I will see what kind of adjustments I need to make today. Brandon says, "Welcome to the pain." Deeply good morning. Buffalo, step away from the ledge. That is correct. All right, so I did transfer 1,500 out of this account, so you can see the pending cash here. Let's minimize. What's up, Emperor? I kind of have like I have like a circular economy with all my accounts. So the way that my wife and I have this worked out is we actually pay ourselves an allowance, right? So we each get an equal amount of spending money, and I barely spend any money. So I just plow most of my spending money right back into my account. But like, this is the main account, and this one is my this one's my allowance. And so I did transfer that 1,500 over here because usually the only way, since I don't have a job anymore, the only way that I can actually pay myself an allowance is from this account. And so I take profits from here, then I withdraw it to my checking account, and then I've got the automatic deductions from my checking account to each of our personal accounts, and then I take my personal account and I transfer it back into the stock market. So it's kind of weird, but I do spend a little bit of money. But so anyway, I have to do a little bit of playing, almost like playing the shell game. I'm just moving shit around from account to account. Okay, so down today, obviously, kind of pissed off that my covered calls that I tried to plow in with like 5 minutes left at the end of the day on Friday when the price of strategy was 290. I tried to sneak 2 more covered calls in here. Probably would have gotten at least $1,000 for each of those. In the grand scheme of things, it's not the end of the world, but it's still annoying as shit. So I won't be adding any covered calls necessarily because I want to keep a little bit of, I don't know, like the reverse dry powder for if the market goes back up. But I sold these for 1,200. And here's the weird thing. So generally, I look at this and I'm like, okay, did I collect more than, or can I collect more than half of the premium in less than half of the days to expiration? So in this case, and it kind of depends on if you include Saturday and Sunday as days, because if you don't, then there's 7 days to expiration, and I would have collected, half in 3 days. So Saturday, Sunday, and most of Monday. And in that scenario, I'm basically just kind of trucking along, and there's another 4 days to expiration to collect the other half. I'm really in no rush to close this. And if that doesn't make any sense to think about it that way, the other thing that I will do is the criteria that I will use to decide whether I want to close this out and take this position off is imagining that if I didn't have this position on, would I put this position on today? Potentially, because if it makes sense to put it on, then it doesn't make any sense to take it off. And so there's 4 days left to expiration. And so if I was to go out there and sell the 290 strike today, I could actually get over 2% return on capital, right? So I could buy 100 shares for 260. I could sell the 290s for 570. 1% return on capital would be $2.60. So 2% would be 520. So a little bit over 2% return on capital just for 4 days, 4 days to expiration. So that's a pretty nice return. So even though my other criteria says, well, I can close this out for half of what I paid, the other kind of side of that coin is there still enough left to make this trade worth holding on to? And both of those answers are basically yes. Like I kind of have this, on one hand, I have the urge to close this for profit. And at the other hand, I'm like, but selling the 290, making 2% return on capital for a week, and the price can even go up 10%, right? From 267 to, if we had another $27 to that'd be like 290. So the price of strategy can recover 10% and still stay under this 290 strike, pretty close. And I can get 2% return on my capital. And even just as I'm talking, I've been running my mouth for fucking a few minutes, and just like 30 seconds ago, I was able to buy this back for 6, half of what I paid for it, and now it's 75% of what I paid. So I'm kind of talking myself out of closing this right now. Like, if it made sense to close it when it was for 570 or 590, I don't think it's really worth it to buy this back now. And really, the only reason that I'm staring at the computer like this every single day is for the recordings. Like, if you want to do this on easy mode, like let's say you have a real job, you don't have to be in here on Monday and Tuesday and Wednesday and Thursday looking at this. I mean, you can just, if you want to sell weeklies, you can come in here on Friday and sell your weeklies. And you don't even necessarily even have to come back in on Friday and close them out. You can just let them expire if you want. You can let shares get called away, or if they expire worthless, you can just do that. Then you can pop back in on Monday and open up some stuff, or you can do like a Friday to Friday thing, or Fridays and Mondays. When you do get a big price change, it can make it more optimal to make some little adjustments in here and there. But you can really just trade this on easy mode if you want. You don't have to be in here every day. And these ones that are 45 days to expiration are even more extreme than that. Like, you only have to really roll these 45 DTE short calls every 2 to 3 weeks. So you could really just do it once a month. You could put them on at 45 days to expiration, come back 30 days later, there's 15 days left, roll it out to 45 again. You could just do that every 4 weeks on a Tuesday. If you want to, if you don't want to be in here staring at the computer screen every day. That might not be optimal, because you might not be able to squeeze a little fraction of a percent out by adjusting these positions, but it's really not that. This is a very low maintenance thing. It's high frequency trading to the extent that it's not just it's not like a dead man's portfolio where you buy and then you just come back 10 years later and look. So it's high frequency trading, but it's not day trading, and it doesn't really require that kind of day trade intensity. And so here's the thing why tastytrade really doesn't recommend the weeklies. They really like the 45 days to expiration. And it's because at 45 days to expiration, theta is accelerating at its maximum. Well, it's reached its maximum level of acceleration, and they try to roll their calls every 2 to 3 weeks, but it's not because theta stops accelerating, because theta is accelerating like a mofo on these weeklies, right? It has to. There's only 4 days left for $555 worth of value to drain out of this option. It's like, it's like your car with the freaking gas pedal just mashed to the floor. However, as you can see, I could have closed this option for, in the 5s, and then a couple minutes later it was at 8, and strategy has collapsed back down, whatever, $5 to $10 a share. Just as I've been talking, it's been up and down, and it's back down to 5 again. So now it's like, okay, this just makes sense to close these positions. And I'm sure if I just stayed on this live stream until 4 p.m. for another 3 hours, I could watch this just go up and down and up and down, and I'd be like, trading in and out of this damn thing every other 5 minutes. And the reason why this is fluctuating so rapidly is because of gamma. And some people will call it gamma risk, because the closer you get to 0 days to expiration, gamma just starts fluctuating wildly. If this thing starts to go in the money, out of the money, the delta will start ping-ponging back and forth from 0 to 1, 0 to 1. And since gamma is is the measure of how quickly delta is going to change. If delta's flip-flopping from 0 to 1, like if this was Friday at 3:55 p.m. and this was going from 289 to 291, right? It would be popping in and out of being in the money. And so delta would just be like 1. Oh, now I'm 0. Oh, now I'm 1 again. Now I'm 0. And gamma is just like just getting whipsawed all around back and forth. And so tastytrade likes to get out of these trades while theta is still high, but gamma has not really gotten to weekly levels yet. So that's their thing. I don't particularly mind the gamma risk. And I think the reason why I don't mind is because I have so many of these long positions that if this were to suddenly go like wildly in the money, like if this just went freaking ballistic to 350 a share and I got absolutely wrecked on every single one of these positions, I've got these long calls as protection against having my shares called away. So I can just exit. I can exit any of these leveraged long positions, my poor man's covered calls, in order to pay for that. But if all I had was 1,000 shares, like if this entire account just held 1,000 shares and 10 covered calls, then I'm screwed at that point. Because if we went, let's just say that these were the 300 strikes. I want to make the math easy. 300 strikes and it goes to 350. Now I've got to come up with $50 a share times 100 shares, right? $5,000 times 10 positions. Now I got to come up with 50 grand to roll those positions. And if I can only get another like $1,000, right? I got 1,200 this week. I could probably get closer to 1,500. But so let's say I get paid 15,000 to roll them. I still got to come up with another 35 grand. Where am I going to get it? I would have to just concede defeat and let 100 of my shares get called away at the 300 strike. That would give me 30 grand. And actually, yeah, that wouldn't even cut it. I'd still be $5,000 short. So I might even have to let 200 shares get called away at that point. And then with my my 60 grand minus the 5, minus the 35, I could like sell the, I could sell a put or something. Maybe I could sell like the 250 strike put and still kind of like, I could put that capital to work, but my overall position size would decrease. So that's the danger of just holding shares and selling very aggressive, weekly covered calls. And if that type of leverage, or if that type of danger of having your shares get called away causes you to lose sleep at night, then definitely do something else. Not financial advice, but that's just mental health advice, really. So now I've been talking long enough that I can sell these for half price again. So maybe I will close a couple of them, but let me just check the, maybe I'll close. I'll really piss off the market. So I'm just going to close 2 of these, and then I'm going to fucking run my mouth some more. And, maybe the market gods will smile on me and send the price back higher, and I'll put them back on. Fuck, my bad. Volume down. But that does give me, so the price is down. If the price is down, I generally like to add leverage. And the leverage that I'm currently adding is out to September. It's still got 165 days to expiration left on it. And how much cash do I have? I got 4,800 minus the 1,500 that's transferring out. So that leaves me with about $3,000. I'm going to leave a little bit of that in cash. If at the end of the week, this were to suddenly go in the money to, if we're back to 300 or something, this would cost me about $10 a share times 6. Actually, that's only about 600. $10 a share times 100. Oh, it's 1,000. That would cost me about $6,000. So I'll keep a little bit of in cash, but let me just add like 5 of these. It's gonna leave me with about $2,000 in cash. So I think I'm kind of okay there. I've been really trying to hold on to this $1,000 shares as kind of like my base of no leverage. But if we do crash below 250 and stay there, I think before market this was down to 250. But I'll come back to this later in the challenge account, which is getting wrecked. I think I'm like 35,000 grand down behind MSTY at this point. And it's going to be even worse in about a week when I get paid another dividend. So yeah, if the price jumps back up to 270 or something, maybe I'll add these two back on and just kind of basically just skimming a little bit off of this. The final thing that I'm going to check before I finish up with this account is I still do have a pretty significant positive theta here, which is nice to see. You can't really be an option seller's account if your net theta is a negative. This is crazy. So actually, you know what? Before I move on to GameStop, let me just check all the rest of my positions. Okay, so this one, it's less than half of what I sold it for. So this is kind of making sense. It's got 32 days to expiration on it. It's only been open 10 days, but that's enough to roll this out. So I'm going to go ahead and roll my expirations out to 45 days. That's going to give me 2 more weeks. And real quick, so it's the 200 strike is worth 113. If I add those two together, that gets me to 313. So as long as I'm selling something over the 313 strike, it should be relatively safe, meaning I shouldn't be able to have like an unlimited loss that would wreck my account. So I can't just sell like the 290s. That would put me in a bad position if we get a nice V-shaped recovery, which I fully expect, by the way. Like, I don't know if Trump's not like an idiot. He just, I think Dave Smith puts it well. He says he just doesn't seem like the kind of guy who reads a lot of books. So and there's different types of intelligence, right? Like, I like math, but I thought my son and daughter were like, oh yeah, I'm gonna help them with their homework. I'm gonna enjoy math, so they're gonna enjoy math. My fucking daughter hated math. There used to be like tears and shit involved with homework. My son didn't mind it as much, but he ended up turning into a musician, so he clearly didn't like it that much. But I don't know if the guy like really thought, okay, you know what, I'm going to crash the market with the tariff talk, right? I'm going to cause a tariff tantrum, and as long as I do it right away within the first 6 months of my term, then I can just blame it all on Biden, which it really kind of is all Biden's fault. But then who was before Biden? Trump. Well, Trump fucked up the economy before that. I don't give a shit what the market was doing. Every president from the last 100 years has fucked up the economy, right? They've just been kicking the fiat can down the road and extracting wealth from us. So politics aside, certainly every president of my lifetime is responsible for the current problem that we're in. But the point is he hasn't been president long enough to really have to take accountability for anything that's happening right now. So it's the perfect time to really just piss off the market, and then he can get the Federal Reserve to capitulate and lower interest rates like he wants. They're probably just putting a thumb in his eye for right now and trying to dig in their heels and resist. But the federal government can't pay the interest at current rates, so the interest rates have to come down for that reason alone. But the cherry on top is that Trump can tank the market, blame it on the last administration, and to a certain extent, rightly so, and then come in and save the day by sending the economy in full swing. Now, of course, that will come with a metric fuck ton of inflation as soon as we lower interest rates and start the money printers go burr again. But that's going to suck for everybody who doesn't own Bitcoin and doesn't own stocks. But then he gets to, ride off into the sunset, probably at least by the midterms next year, and through the rest of his term, he's probably going to want to see record high stock market so he can pat himself on the back and claim victory and basically cement his legacy. So I don't know if he's smart enough to have masterminded all that, but somebody in his group probably at least is. And so I don't want to say that this is all 100% manipulation, like they're just know every single move that they make is going to result in a certain way, but it is pretty convenient. So I'm not worried about a recovery. Everybody knows that you are supposed to buy when there's blood in the streets, and the most valuable asset is Bitcoin. So going all in on Bitcoin on this dip is at least makes sense. And then my thesis on strategy has not changed in the slightest. It's built on top of Bitcoin, and it's leveraged Bitcoin. So the only thing better than Bitcoin is more Bitcoin, and strategy has multiple levers that they can pull to leverage their Bitcoin holdings. So I'm still basically all in on Bitcoin and Bitcoin derivatives, and this is just a buying opportunity in temporary pain as far as I can tell. All right, so we're about back up to 268 again. What did I just close this for? I closed two of them for 6, and I can put them back in for almost 7. That's not really that much of a scalp. I'll probably be running my mouth and miss it, but if we get back to 270, maybe I'll add these 2 back on. So we'll see. Okay. So if this was, I was about to roll this, but now it's a little bit over 50% again. Not sure I want to. Same with this one. This is over 450. And it's got 32 days expiration left on it. I can easily let this go another week. So we'll see. This one's got 39 days to expiration. And I have to be really careful with these because these These leaps that I'm selling them against are not even in the money anymore. So it's very difficult to create a poor man's covered call on a leaps. Well, it's not a leaps anymore. It was when I bought it, I think. That has only 0.6 delta on it. Generally 0.7 and above is where is kind of like the sweet spot. But if you buy it at 0.7 and then the price drops, now you're at 0.6. So that's why a lot of people like to go to 0.8 or even 0.9 delta on their poor man's covered call leaps, so that if the price does drop considerably, it's still in the money. And so clearly this was a poorly selected strike for the price action that we've seen since. If we stayed over 300 a share, this would not have been a problem, but it's been dipping under 300 several times here. So I really can't expect to be collecting a lot of premium against it. And if I try to roll this out even just a week, it's probably not going to get me much. Roll expirations, because I know the formula says that I could sell anything over 373, like 400 strike, but I think that's limiting my upside a little bit too much. So if I go out another week at the 450, yeah, for like $100 credit, this isn't really worth my time. And especially if you can see the bid-ask spread here is between a $5 credit and a $2.7 debit. The liquidity on this option is pretty shitty. So I'm not inclined to really roll this at the moment. Maybe give it another week. All right, let's move on to GameStop. Actually, maybe I'll check the chats first. Now I'm wondering if I should have just sold GameStop weeklies instead of monthly. You sold covered calls or cash clear puts? Dude face, I have an uncle who says always be selling options is what he means. Yeah, that's what I did basically exclusively for like 4 years. And then after I saw Quant Bros 1, I was like, oh shit, this might actually be worth buying options. And that did work out pretty well in November, but I failed to capture and take advantage of those long calls that I could have all closed for profits. So I'm still learning on when and how to exit my long call positions. See, in my opinion, there's a difference between an evangelist, a guru, and a teacher. Yeah, that makes sense. Covered calls. Yeah, how far did you go out of the money? Like, with my weeklies, I generally tend to sell pretty close to at the money. I'm like, if I'm throwing caution to the wind, I might as well just blast away with not a whole lot of call away value. But if I'm selling my 30 to 45 days, I'll go. Let's just look at GameStop. Like if I was going to open some 30s today, I would probably go at least outside the expected move. This little line right here is Tasty Trade giving you what the expected move is predicted to be. Or if I want to be a little bit more conservative, I might even go to the 1 SD line, so 1 standard deviation. Victor says, do you ever arb across IBIT and strategy? No, I do not. I found it a good way to pick up extra IBIT along the way as the NAV premium fluctuates. Yeah, if you can make that work for you, great. I know some people will watch, and if it's like I don't know, if one of them, like if Bitcoin is up but then, IBIT is up, but strategy isn't up as much as the leverage ratio makes it seem like it should be, then maybe strategy's a buy. And then if it's in the other direction, then I guess you'd sell some strategy to pick up some IBIT. Yeah, I don't really, I don't rebalance in between those two positions. However, it does make sense, right? So like, I hate to mention his name because he started shitcoining, and but anyway, Fred Krueger had a decent video way back in the day, and it was around the Kelly criterion that gamblers use to make sure that their bet size is appropriate, that they never go broke, right? Because you're gonna, even if you're gambling correctly, you can still have wide swings in outcomes, right? Even like flipping a coin has a 50-50 chance, but you could still flip heads 10 times in a row, right? If you flip a coin a million times, there's going to be many times where you're going to flip the same side, 10, 20 times in a row. But then, over millions of individual attempts, it averages out. So he used the Kelly criterion to show how someone who was just investing in Bitcoin could rebalance their portfolio between Bitcoin and cash, and I can't remember what the optimal percentage was. It might have been like 60-40 or 80-20 or whatever. And then, if Bitcoin goes up 5x, now your ratio is off and you're just rebalancing. And it's really nothing different than the old 60-40 portfolio from stocks to bonds, right? If the stock market went up 10x, well, now your 60-40 is like 90-10. So you have to take some profits on your stocks, load up on bonds. Then you have some shit goes down, like what's going on right now. And the theory was that you'd have a flight to quality, or it was flight to safety, and the bonds would become more expensive. And then the bonds might become 60% of your portfolio, and then you take some profits on your bonds and buy back into the stock market. So it's literally just rebalancing your portfolio, which is one reason why I don't really mind if people are like trying to time the market with Bitcoin and trying to time and sell the tops, because it just seems real like it's literally just rebalancing a portfolio. And so what you're talking about is having IBIT and strategy, which should be positively correlated, right? They should be both be going up when Bitcoin goes up, but at a different rate. And so if you notice that the correlation that should be taking place is not happening, and you're basically detecting that one of them is undervalued, it absolutely, does sound like it makes sense to rebalance that position and trade out of the overvalued one into the undervalued one. I think that's just a trading pair, right? You can have trading pairs that are positively correlated or negatively correlated. And then, when one of them goes up and the other one goes down out of the expectation, then you can arb that, like you said. So it does make sense to me, but I don't do it. Emperor, I'm doing 10 Delta 30 days. Indifferent to GameStop. Just going to run the wheel for a while. Yeah, the 10 Delta is probably fine. Let's see, 30 days. Oh, 10 Delta is way up there. Holy shit, that's like at the top of the chart. Collecting $50 there is like 2% return on capital. 1% if you close it every 2 weeks. So that's about collecting about 0.5% a week. So over the course of a year, that would be 26% return on capital. But if the price goes up from $24 a share and your shares actually got called away at 50, you double your money on your shares on top of collecting that 26%, which would be like the icing on the cake, basically. So, but what was the earlier question? Let's see. You said, wondering if you should have just sold weeklies. Oh, instead of the monthlies. Yeah, it just, in a sense, it doesn't matter. Like, one of them is going to be optimal over the other, but I don't think there's any way to really tell. And I think, like right now, you're not collecting that much premium. So you're probably like, oh man, I should be selling the weeklies to collect more premium. But if this fucker does hit and GameStop goes to 50 a share, you're probably going to be glad that you have these these 10 deltas. But yeah, I mean, 6 months from now, if we're still sitting at $24 a share, then you're going to be pissed off at yourself. So you just don't know what the future is going to bring. I'm not exactly sure if I believe in the efficient market hypothesis, but I do think that for the most part, the options are generally fairly priced. So like some people prefer the 10 delta. Some people prefer the 20 delta. Some people prefer the, the 30 delta or whatever. I don't really care. I don't think you can just come right out and say, oh, there's an advantage to a particular delta. Now, the other thing, the advantage that the 10 deltas do give you is that if the price does shoot up to 30, you don't have to roll them, right? You don't have to roll those out until they get close to 0 days to expiration, and then you can just decide to roll or not roll. You could exit that position out completely. Or if the price went to like 55 a share, it's going to be easier to roll your 45 strikes out to 55 than it is to roll these at the money 25s, right? You're going to go, if I'm selling the weeklies, the price goes to 50, I ain't rolling shit. Like I'm out of options there. They're just getting called away. But as you said, you got no love really for GameStop, so you don't mind if they get called away. So in that sense, yeah, it might be worth. That's kind of what I was doing. I sold the 23.5, so these might get called away immediately this Friday. And if they do, I'll probably just immediately put in another cash secured put position at the money and just plow another couple grand back into it. I won't do that if this rockets to like 30 or something, but I'll run the wheel back and forth a little bit, kind of like you said. Yeah, I don't think there's any perfect option, right? Like I can't say, oh, I think the at the money weeklies is better or worse than the 10 deltas that you grabbed 30 days out, because you just don't know what the future is going to do. If the price is still $24 a share 3 months from now, then the weeklies are going to print. But in a month, if we're at $50 a share, then you're going to be glad you had the 0.1 deltas, I think. What's up, Howard? Good to see you. Let's see if that was the plan. I'm going to force myself to take profits if GameStop actually rips, if they are a serious Bitcoin treasury company. Yeah, fingers crossed, dude. Jamil, what is your strategy behind buying the 919, 1080 strikes? These seem the most susceptible to IV crush compared to 919, 600, or 500. So we're going to have to define terms. Good question. But generally, when I talk about IV crush, what I understand that to be is, this is Market Chameleon. This is an implied vol chart. And Strategy really hasn't been an earnings play company, in my opinion. It doesn't seem like the market really gives a shit about Strategy's earnings calls. That may change when they get fair market FASB accounting. But usually what you'll see here is, let's just pretend this is Tesla. So what normally happens is, instead of this IV going down, IV's like going up. And then you get earnings, and then IV goes down. That's IV crush. And then implied vol would increase as the anxiety for what the earnings result is going to be. And then boom, it crushes. It would go down. And then it would go up again, and it would crush. So that's what I think about when I hear IV crush. And if you just mean if implied vol sinks, and because of Vega, the 1080s are susceptible to a collapse in Vega, then I think that you would be correct. But I don't know if that's not really what I think about with IV crush. So if you're thinking Vega risk, then absolutely the 1080s have huge Vega risk. Oh shit, strategy's back up to 273. So I'm gonna put these covered calls back on. This is just kind of like a scalp. This is just me fucking around. But I bought these back for like 5 something, right? I bought them back for 600. And I'm just gonna put 2 of them back on for 840. That's not like master trade of the century or anything, but look, I'm online, right? I'm paying attention to the fucking price, so I might as well scalp it a little bit, right? In the long run, scalping a couple $100 doesn't really mean much, but hey, I'm staring at the screen, might as well take advantage of it. Okay, so back to the 1080s. So if you're following, so you're posting from YouTube, and I don't want to call it a Twitter battle, but there's, November happened and a bunch of people made $1 bajillion, and I quit my fucking job just to make money in the stock market. And what happened was in November, let's see how far this goes back. I don't know if Tasty Trade has it, but I really like the this historical chart. This is only going to go back to, oh, actually, this is perfect. So the 1080s on November 22nd, when strategy was at 500 a share, these motherfuckers were worth 12 grand. And so when the 1080s came out, if you had made a shitload of profits, and when the 1080s came out, you were like, ooh, shiny new toy, right? And you rolled your, what did you mention, the 5s or the 600s? Yeah. So if you took profits in your 5s, your 600s, your any strike whatsoever, it doesn't really matter. If you came out and paid $12,400 for the 1080s, and then you watch the price of strategy collapse from 500 to 250, you've lost 99% of the value. So the 1080s are the riskiest strike that you can select. But what is the potential reward for the riskiest stock or strike? Well, you could buy them right now for, these are the Julys, right? Yeah. So you could buy the Julys for 64 cents. Well, and if the price rockets back to 500, 600, 700 a share, well, you might make 10 grand on that. So leverage sucks ass when you're buying at the top and getting wrecked when the price goes down. But if you're buying at 100 and it goes to 10,000, well, it's time to pop bottles, right? So I'm going to read this question again. What is your strategy? So the strategy is, let's view all options. September. Let's take a look at the 500s that you mentioned. The delta on this is 0.25. So if I wanted exposure to 100 shares of strategy, I would need to buy 4 of these bad boys, right? 4 times 25 is going to get to 100. And that's going to cost me $2,000. I'm just going to round it off for easy math. And times 4. So that's going to cost me $8,000, right? Delta on this one's 0.04, which means I would have to buy 25 of these to get me to 100 delta. And 25 times 259. I'm just going to round this up to $3. If this cost me $3 a contract times 25, that's only going to cost me $7,500. So less than $7,500, I can get the same leverage, right? With the 1080s, I can get the same leverage for a cheaper price. Or the other way of saying that is, I can get more leverage for the same price. That doesn't mean that the 1080s are the perfect option in strike. There's no perfect option. But if my goal is to buy the most delta I possibly can for the cheapest price possible, then the answer to that criteria is the 1080. So what are the trade-offs? Because Thomas Sowell says there are no solutions, only trade-offs. And the trade-offs are that theta is pretty high compared to the value of this option, right? So it's only worth $265, and it's losing value $5 a day. So you need this thing to hit, and you need it to hit pretty quickly, which is why I don't really buy options under 90 days, because I just feel uncomfortable being that close to expiration. So let's go back down to your 600s and try to remember, no, 500s you had. So while theta is, so this is a little bit weird. So theta is actually somewhat higher, right? So the 500 strike is losing $17 a day, but theta is lower if you compare it to the value of the stock. Because the value is like, what is it, like 6, 7x? The 500s are 6 or 7x the price of the 1080s, but theta is not 6 or 7 times the theta. It's only 3.5x the theta. So with the 1080, you can buy more leverage for cheaper, but the value is going to disintegrate faster due to time decay. So the 500s that you were talking about are a much safer investment, and it won't decay as quickly. So you can kind of like, you could even, cross your fingers and hope to go in the money at some point before this expires. But I don't buy the 1080s thinking it's going to 1150. I buy the 1080s hoping it goes to 650 and I can make like, 10x off of this or something. So like, let's just say I own 10 of these. If the price goes to $5 a contract, I would probably sell half of them so that now I can't lose money. Well, 330, or excuse me, 530. If these 265s went to 530, I could sell half those contracts and make sure that I, even if they expire, the other 5 expire worthless, I would have basically guaranteed a break even. And then if the price went to 750, I could sell another one. And then if the price goes to 10, I could sell another one, and then, maybe hold one of the 10, all the way to expiration, or, hopefully I win the lottery and strategy goes to 2,000 a share or something. So that's kind of like a profit taking strategy, along with, that's like secondary to the strike selection. If you're buying the 500s, then I'm much less worried about it expiring out of the money, right? Like if we don't end the year over over 500 a share, then I'm calling my entire life a waste of time. Like that seems like an impossible scenario. So your profit taking strategy can be completely different with the 500 strike, but neither one of them is better than the other. It's just, for me personally, if I want to bet on a completely speculative play, I'm just going all the way to the top of the chain and just buying the cheapest thing that I can get and give myself the most delta exposure for the least amount of money, right? It's like going and shopping for gas and looking for the cheapest 87 octane you can find. You can buy the 500s. I guess that's like 93 octane or something. And I'm just gonna, I'm gonna use the money that I saved here to buy more contracts with the same amount of money. So hope that answers the question. Dudeface, what you bring to Bitcoin is practical application of CBOE, which honestly is needed. Jeff Park is spreading the gospel and bringing new people in. Cool. Appreciate that. Yeah, I'm going to keep doing it for now. I think it's fun. All right, so strategies at 275. Huh. What can I sell these 290s for now? I think, in case we just get some kind of amazing recovery, I'm going to wait. I've got 1,000 shares, right? So if I sell 2 more, I'll probably wait for the price to get up to closer to 290 before I make that happen, assuming I'm actually paying attention. So yeah, so this one has 30 days left, 39. Yeah, nothing else for me to do in strategy. All right, so GameStop. I should have just went all in on GameStop, huh? It's fucking GameStop is a flight to safety. That's ridiculous. All right, so the 2350s that I sold for 78 cents will probably get called away if everything continues for the rest of this week. I have 2 of the 125 calls. These are like my GameStop version of the 1080s. So there's a couple of things. Yeah. I'll probably just continue to roll the wheel here. But at some point, like if the trade price goes to $1.80, I'll probably just take my own advice here and just sell one and double my money. But nothing to really do now. I think what a lot of new option sellers do is, as soon as their strike gets threatened or breached, they start to like panic and, pee down their leg. And this is not a big deal. Like if you're running the wheel, this is not only fine, but this is expected. Especially since I chose such an aggressive strike. Like I should be expecting to get my shares called away like every other week. This should not be a surprise at all. And literally I will break even because my cost basis is 2350 minus the premium that I got paid. But so I will be buying them for 2350 and selling them for 2350. But what I will be keeping is the $78 I got paid for this option. And I can't remember what I got paid when I sold the cash secured put in the first place. Or did I just buy 100 shares? I don't even remember how I entered into this. No, 2350. I must have sold the 2350 put. That makes sense. Because I wouldn't have just bought 100 shares at exactly 2350. So yeah, so I sold the 2350 covered cash secured put, got assigned. So my true cost basis is really 2350 minus whatever I got paid on that premium. And then I will exit this position with no loss or gain. And I will have kept the premium, the cash secured put that I sold, plus the $78 that I got paid for the covered call. But yeah, so if you're running the wheel, this is normal. Shares get assigned, shares get called away. It's not anything to freak out about. What generally they do when they panic about this, which when you're just buying and selling stocks, you don't want to panic sell when a price goes down. Well, the same thing is true when your covered call gets threatened. You don't want to panic roll, right? Like, oh, the price is 24, so now I have to roll up this 23 strike to 24.50, right? Well, that defeats the purpose because my goal was to get paid $78. Now I'm going to have to pay, if I was to roll this to, let's roll it up. If I roll this to just out of the money again, I'm going to have to pay $50, right? Just to hope that it expires out of the money again. Well, what if, GameStop follows the rest of the market and it drops to 22? Well, now I paid $50 to roll up for no reason because my 23.50 would have expired out of the money too, and I could have just pocketed all the money. So this is called getting whipsawed. If you roll to a higher strike and then the price of the stock goes back down to where it was to begin with, you can just end up spending more money rolling than you got paid in the first place. All right, so GameStop, nothing to do here, but just sit on my hands and wait. The Tesla position, I am tempted. I'm tempted to, I'd really like to add some positions here, but I kind of can't afford it. Since I don't have any money other than what exists in this account or in the stock market, the only way that I can add positions is if I take profit in other positions. And with strategy being so far down, as much as I would love to add another Tesla position here, I can't justify it, right? I'm not going to take profits on strategy. If I had like 400 shares of GameStop, that might make sense because I could sell those 400 shares and that would pay for another Leaps. But as it stands, can't really, as much as I would love to buy the dip with Tesla, I can't bring myself to do it. So do I need to tweak this position? Not really. It's got 39 days left on it. It's got like 70% of the sale price left on it. So nothing to do but really just sit here and wait. The next time I sell, like maybe Friday, if I sell my covered calls for the week and I end up with like 8 to 10 grand here, maybe I'll add another Tesla position if it's still down more than strategy is. But for me, this is going to be my version of a, not really a pairs trade, but a rebalancing. So instead of like the Kelly Criterion example of rebalancing between Bitcoin and cash, I'm going to be rebalancing between Tesla and strategy. That's my game plan, probably for the next decade, really. There could be other risk-adjusted investments in the stock market, but I'm not aware of what those would be. My criteria for investing in a stock is basically the one that I stole from Saylor himself. listening to his podcast, and those two criteria are number one, disrupting, and number two, the clear winner. So Bitcoin is disrupting everything, and they're the clear winner. All of the other cryptos are either inferior or outright scams. And Strategy is a leveraged Bitcoin play. So whatever you believe about Bitcoin, Strategy will have higher returns, but of course you can't self-custody Strategy. So there's definitely trade-offs there. I'm not saying Strategy is better than Bitcoin, but just based on returns, I would say Strategy will will deliver higher returns than Bitcoin itself. And I don't even mean just returns on money. Like if you're still stuck in fiat and you're still counting in US dollars, I mean like putting money into Strategy or Bitcoin. A year from now, you'll probably be able to purchase more eggs or cars or houses with your Strategy investment than your Bitcoin investment. I don't know if that's sacrilegious for a Bitcoiner to say, but pretty confident about that. However, there's third-party risks, right? So there could be some governmental policy that affects Strategy that doesn't affect Bitcoin, because Bitcoiners can just put their money in their brain wallet and flee to another country. So, Strategy has to follow laws and the SEC and blah, blah, blah. And there's key man risk. There's tons and tons more risks to Strategy that you don't have to deal with Bitcoin. So I'm not trying to make all of those comparisons. But yeah, that's my plan for the next 10, 20 years, is to hold primarily Strategy and Tesla. If something else rears its head, like I'm just screwing around with GameStop. This is fun. But if something else came out, like, I don't know, if they figured out a way to genetically cure cancer and like a whole bunch of other genetic diseases or something with the CRISPR or the blah, 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 and they were they were Bitcoin companies on top of that, like maybe I would consider something there. But for me so far, disrupting and the clear winner is Strategy and Tesla. And I can't really imagine a scenario with the direction that the world is headed in that these aren't the two most profitable stocks in the world for the next 2 decades. So not that I should have any specialized knowledge, but I get my daily Tesla hype from this account called Stephen Mark Ryan. And he comes out with basically an episode practically every day, I would say. So that's where I get all my Tesla info from, for the most part. There was a couple other good channels, was like Electric Viking and what's the other guy's name? I can't remember. But I will, if Strategy doubles, triples, quadruples in the next year, I will be taking all of those profits and plowing them into Tesla until I could get probably a roughly like 50-50 portfolio together. All right. I've got to blast through the rest of these accounts. So Misty's doing whatever the hell Misty's doing. I don't even have to look at it. And that's the advantage to something like a Misty. Like if you want to generate premium and let somebody else do it for you, I suspect, I have not looked at IMST yet, but I suspect that the Bitwise product is probably going to be better, just for the simple fact of supposedly Jeff Park is managing it, and I think I have more of his tweets bookmarked than like any other person that I follow. He frustrates me a little bit with some of his shit coinery, but I don't know if that's just an age thing. Like meme coins are just like, I don't know. Anyway, I love, what is it? He has, what is his modern portfolio theory or whatever. I think he was talking about the new 60/40s, like Bitcoin and like Bitcoin and Strike or something, Bitcoin and Strife or Bitcoin and Strike. Anyway, something like that. Or was it? Yeah, I think it was like Bitcoin and Strife or Strike. Anyway, he's got a lot of cool novel ideas that I really like. So I suspect he will at least be intelligently managing that covered call account. So kind of annoyed. I'm already in the MSTY challenge. I don't know if I can really spare a bunch of cash into another challenge. Plus, the other thing that you run the risk of is, like, if you have too many positions, they just become harder and harder to manage. So if I add another challenge to the mix, I would say I'd probably end up with at least another 10 positions that I have to watch, and it just becomes cumbersome. Like I'm going to spend more time looking at the positions, covering them during the videos, and the whole point of really adopting Bitcoin is so that I can get more of my life energy back to things that I want to do. So I don't know. We'll see. I want to do an IMST challenge along with it, but one thing that you'll notice is that, like, I'm only trading strategy in Tesla and, you know, a handful of mining stocks and GameStop. But one thing that you'll notice, if you start picking up 5 tickers and then 10 tickers and you've got 20 tickers, you will start fucking up. You'll start making mistakes because it's too hard to manage. So every once in a while, it can actually be to your benefit to prune positions. Like, I've got another 12 days before I definitely am dumping these Julys, but I could just dump them now and plow the $300 into one more September. That would just give me one less position to keep track of. Like, that's perfectly fine to do. It's called pruning. There was a book that was actually for creatives that this guy recommended. Like, you have to prune in all areas of your life, right? Like, it would be cool to have 100 close friends, but you really couldn't meaningfully keep up a close friendship with that many people. Were you going to go out with one friend a week every Friday for 100 weeks, and you're not going to see the first friend again for 2 years? So, you know, it's work-life balance. It's the same with a portfolio. Once the positions start to get to be too many and the tickers start to become too many, it's just too much to handle, and you'll miss something, right? Like, you know, if I wait 30 days before I roll these because I meant to roll them at 90 days to expiration and now it's 70 or 80 days to expiration, that might not be the end of the world, but it might also not be optimal. So just keep in mind that you're going to be tempted to add more positions, add more strikes, add more expirations, add more tickers. And if it reaches a point that becomes too much to handle and you start making mistakes, then it's time to prune those things down and consolidate. All right, so do I roll this? It's got 32 days expiration on. I could roll it for half, because it is below half of what I paid. Let's see what I can get if I roll 246. Small credit at the current strike. But look at the bid ask spread on this $3.95. It's $8 wide. That's like terrible. I think this May 23rd. Yeah, well, it's a weekly. I don't know why this May 23rd liquidity is so bad. But the bid ask on this, on closing this one and opening a new one, is $9 credit versus a 40-cent debit. That's $9 wide bid ask spread on this trade. So I don't know what the deal is on this, but liquidity is extremely important in options trading, because it might seem like you're going to make a bunch of money selling that option, or buying that option if it goes in the direction you want. But if you can't exit the position when it's in profit, it doesn't do you any good. So this is kind of annoying. Let me see if I roll it 2 weeks. No, there is no 2 weeks. So the May 30th are not available yet. So I can't even roll this out to 52 days to expiration. I don't know when they're going to populate those. But this is a little bit of a pain in the ass. I guess I'm just going to have to sit on this one, even though it seems like it makes sense to roll it right now. That's a little bit of a pain in the ass. All right, so Tesla. Tesla is still worth about 66% of what I sold it for, so not in a rush to roll this one. My 800 days to expiration call is getting wrecked, but not really worried about that in the long term. So nothing to do here. This is the allowance account that I mentioned. I transferred 1,500 over to this one, but it hasn't hit yet, so probably won't have anything to spend here. 32 days to expiration. I could roll it now, but as I just showed, the liquidity is kind of shit on this one, so I'm just going to hold off. Maybe if the volatility chills the fuck out, the bid-ask spread might narrow a bit. All right, so this is the challenge account. If we were sitting at $2.50 a share, I would sell 100 shares, which would be at a loss, and then I would buy 2 leaps. I'd probably grab 2 of the 200 strikes, maybe, and then sell 2 poor man's covered calls against them. But we've recovered a good bit since I was worried about us hitting $2.50 a share earlier this morning. So I don't think there's really much of anything to do here. There's plenty of extrinsic value left in these 290s. I'm not going to roll these. And yeah, all my point. Well, this poor man's cover call ready to roll. No, not really. Close, but no cigar. Yeah, I got 12 days to for some amazing shit to happen with Strategy's price, and I've pretty much lost hope in these Julys. These are all going to be giant losers. I will scrape together whatever I can on like April 18th ish, and I'll probably just roll them out to September. So whatever I can roll these Julys out to September and get, that's what I will do, and then hope we get some good shit happening. I'm still getting wrecked pretty bad. I think I'm down like about 30 grand ish, 30 plus. against MSTY since mid-January. So in 3 months, they're wiping the floor with me so far. This is a good thing to look at, I think, just to see how the whole market is in general. And this little blip right here, this is COVID. So we were at all-time highs, 320 S&P 500, and just the market dipping 20% in a couple of months caused us to print money like it's going out of style. And then we got this V-shaped recovery. So anybody who just hodled, has doubled their money since. And anybody who didn't panic sell here at 250, again, has doubled their money. And so we topped out at 610, 605, something like that. And so now we're down 20%, right? 20% off of 600 be 120, 480. I think weren't we down to 480 earlier? Yeah. So we had like 20%. We're down 20% in 3 months. February, March, April. Yeah, 20% in 3 months. So not quite as drastic as this COVID drop, but like it's not going to be very long before the money printer go burr. And does that mean that they won't have a standoff with, that Trump won't have a standoff with the Fed, and we see 475, 400 again? No, we could see 400 again. Like, we could see anything. But eventually someone will blink and it'll be off to the races again. And this panic inducing 20% drop right here will be this 20% drop. And 5 years from now, the market will be double 400 a share. You know what I mean? In 5 years, this will be 800. S&P 500 will be at 800, 1,000, or whatever. And no one will remember how we all had to be talked off the ledge on April 7th, 2025. It doesn't mean that your July 1080s are safe. They're not. They're completely fucked. But I mean, unless you're buying them today, you might be all right buying them today. But my cost basis on my Julys are $7.55. That's not going to cut it. There's no way I'm breaking even on these. So, okay. I'm still not buying these now. I'm still not buying Julys now. They could work out, but I've already moved on to September because I kind of feel like there's enough time to be right there. If Trump and the Fed and China battle it out over these tariffs and shit over the next couple of months, I'm still fairly confident in my September's printing. Especially since I bought them at reasonable prices, right? The price was already like 300 a share when I bought these. Whereas these Julys I've had for 74 days. So I bought these when strategy was at like 400 a share or 375. And so, implied vol hasn't been cooperating. The price hasn't been cooperating. So I'm ready to pour a little for my homies on the Julys. Okay, let's just double check a 5K account real quick. My mining stocks all expire on Friday. Nothing to do there. Wolf is an absolute disaster, but it's so hard to get premium in a cheap stock like that I had to roll it out to 45 days. So nothing to do there. I got my 380s. These are rolled out to like 50 days to expiration. Yeah, nothing to do there. Do I have any buying power? No. I had 760 and I sold a $6 cash secured put in something. Iron. All right, so no buying power to speak of. I can't like dollar cost average into these 1080s. And actually it was Jamil. Jamil was asking about the 1080s, but I also do have some of the ones that are more in your wheelhouse. I don't even know if it's still on, but so what Grain of Salt did after November is he decided to roll into more of the ones that were like 10% out of the money. And I decided to grab a few myself. So, I mean, so far they're not like winning, right? But I've got some of the 375s, which are just out of the money. And if we do pump to like, let's say 450 a share, or maybe back to all-time highs of 500, these will do very well. I don't think they'll do as well as my 1080s. However, depending on how much time has gone by, they could outperform the 1080s in the fact that they won't have lost as much from theta. And the reason why he picked the slightly out of the money ones is because the if you look at the gamma chart, you know, I talk about the maximum theta acceleration at 45 days to expiration, and the maximum gamma acceleration happens at the money. So the current price is 275. That's when an option either gains or loses the most value in its delta because gamma is at its peak. So if you can buy something slightly out of the money and then you sell it when it's slightly in the money, you've captured that maximum gamma acceleration. You know, I've just got a small position in that strike because it's not my go-to. You know what I mean? The 1080s are my go-to, but since November, the 1080s have lost me a metric shit ton of money. So, you know, I just talked about pruning positions, but in this case, I'm like, all right, I can diversify, right? I've got the deep in the money calls. Those I'm using to make poor man's covered calls and sell premium against. I've got the slightly out of the money long calls that will appreciate if they go in the money very well. And then I've got my, I guess they call it attack the tail positions of deep out of the money lottery tickets. And I bought a lot of them. I got a lot of these lottery tickets. So I need some of these scratch offs to hit. I'm looking at you, 7-Eleven. So it's a balance. You know, if you get too many positions, you got to prune them. But at the same time, I don't have a diversified portfolio of tickers, right? I've just got strategy and Tesla for the most part. But I do have a bit of diversification in expiration dates, strikes. I've got a couple of call debit spreads here. There's a bunch of different ways to diversify. And so to your point, you were asking about the 500s and the 600s, but I do have some 375s, which are they're a little they're a little bit more out of the money than they were when I bought them 50 days ago, but they're fine. They're doing all right. All right, so that was the last thing I needed to check on the 5K account. And for anybody who is new, the 5K account is, I put $5,000 in this Robinhood account in March of last year, and my goal was to see how fast I could turn it into a 25K account, because 25K is the minimum that you can do day trades without getting day trade violations. And in November, everybody was fucking printing money, and so that's my account, my 5K account topped out at $33,000 in November, but I did not unask myself from all of my leveraged positions. And you can see since November, Bitcoin has been trading down, and all of the Bitcoin derivatives have been trading down. So I failed to capture my profits here. So I turned 5K. It was funny. About a month after I started this challenge, in April, I turned 5K into 3K. And then I turned it back into 5K, and then I turned it back into 3.8. And, it's okay for your account to go down sometimes, as long as it's going mostly up and to the right. I think it peaked here at like 8 or 9. And then I turned it back into a 5K account again. And then, just keeping plugging away at it. It was pretty nice looking here. But as I said, I failed to get rid of all my leverage. I should have went to just straight shares here probably and been aggressively selling covered calls, but I didn't. So the 5K account has been trending back towards 5K for a while. Turned it into 8K at one point at the bottom in February. So I've been kind of clawing my way back and holding strong above 10K still. So after about 13 months, it's still at a little bit of a double. And I kind of wanted to just prove or see if I could still turn a small account into a bigger account, because it's easy to come up here and like throw around 1,000 shares of strategy, but it's a whole different thing to be like, okay, can I even find anything, trading with $5,000, and like, can you generate enough premium to even make it worth it, right? So I sold an $8 covered call against CLSK. See how much I got paid for this. I got paid 18, which was about 2 to 2.5% return on capital for 1 week. So $18 a week doesn't sound like much, but 2% return on capital for 50 weeks is 100% returns, which oddly enough is what 5K to 10K looks like. So like doubling the account in a year. There's a covered call seller that I really respect, and he thinks that I am way too optimistic about earning 1% premium per week. But the volatility on Bitcoin derivatives is so lucrative that I think it's pretty reasonable. Even though it's the $8 strike that I sold in CLSK, that was literally 2% returns for a week. So, 1% returns for a week, 50% returns for the year, assuming that the price of the stock doesn't even go up. Yeah, the option selling is just like aggregating small wins, right? Taking $18 a week, $18 a week, $18 a week on an $800 stock. Excuse me, eight times 100. On an $8 stock, $18 a week is pretty ridiculous. Now, these could get called away as soon as CLSK goes to $10 a share. That's fine. The whole point is just taking small win after small win after small win and letting those add up into something substantial over time. So I got to work on the profit taking part though. I really FOMO'd into too much leverage right here. So please learn not financial advice, but at least have the common decency to learn from my mistakes. All right, I think I'm all done with that, with all the trading for the day, unless strategies hit 300 a share or something amazing. No. All right, Jamil, yes, your clarification is a better articulation of what I meant. I was referring to Vega Risk, not Ivy Crush. But all in all, your strategy makes a ton of sense. Thank you for your answer. Absolutely welcome. Appreciate the question. And thanks for checking out the channel. Dylan C., do you think you need to be an above average options trader to outperform MSTY? How many years of experience do you think you need? Thanks, bro. Debating whether to invest in MSTY or do it myself. I probably overestimated how easy it was going to be to beat them, number one. And I underestimated how much strategy was going to correct before the next pump. So in January, when I started trading against MSTY, okay, that's my account. That's not MSTR. MSTR was around 400 a share. Yeah, strategy was at like 370, 400, 375. And so MSTY was like $25 a share. Let's see. Oh God, they were $30 a share. So I went, again, I screwed myself with leverage. So I went hard with the leverage. I took about 200 grand and I put that in MSTY in one account, and I put the same dollars into my account. And I can't remember how many shares I started with, but it was probably like 600 maybe. So I took about 60% of my portfolio and put it into straight shares. I put the other 40% into these 300 strike leaps that felt pretty comfortable to me because strategy's price was 375. And these were probably like 0.7, 0.8 deltas, maybe 0.75 deltas. So I'm like, oh, okay, I'm good to go here. And as strategy's price collapsed, I kept selling more shares to get more leverage. But I completely underestimated how far strategy's price would correct. And if I had just plowed all of the money into straight shares, I would only be down about, what is that, 10% down to 290. I'd be down about 15% on my share price. And then over 2.5 months, I would have collected a ton of premium. And so I think I would probably be beating Misty if I just hadn't plowed money into into leverage to begin with. And then the other thing that I thought I was doing myself a favor for was taking all the premiums that I collected, and instead of buying more shares or just stacking cash, I was plowing all of my profits into the July 1080s, which you can see is down like $7. So 700 times 37. Let's just do 40. So 40 times 7, 40 times 700 is 28 with 3 zeros. So these July 1080s have cost me like 28 grand. And I'm literally I think I'm literally 30 grand behind MSTY right now. So these July 1080s that I plowed into, you could pretty much call all of the money that the MSTY is beating me by. Not even in like all of the premiums that I've collected has made up for the other, good Lord, there's like another 50,000 that these long calls are down. But all of the premiums that I have collected has made up for this 50, but not this 28. So if I had just stuck with shares for the most part, there's a chance I could be beating them. But I don't know if I let my ego get in the way or whatever, or just miscalculated on how bad the economy could get. I should have known better with all the tariff talk, but I'm still pretty confident over, tracking this for a year, that if we get any type of recovery whatsoever, I will be winning this challenge. Which that was a really long ass way of answering your question. But I think the average options trader would probably have done better than I did, because they wouldn't have overestimated their ability and they might have traded this in a less risky way. I think if the average options trader that just bought shares and didn't add a ton of this leverage might already be beating them. So you have to recognize that you're going to pay them 1% off the top. So are they going to be 1% better than you? I don't know. Maybe take a look at IMST. I haven't looked at their positions, but I still am a little bit nervous about NAV erosion with MSTY. So maybe do a little comparison between IMST, which just came out, and MSTY. But I think the average options trader that kind of just sticks to the basics can out trade MSTY. I'm a little bit biased because I hate paying management fees. Bitcoin Void says Tesla is holding up pretty well, honestly. Yeah, they could be sub 200 with the way the macro is right now. I'm pretty happy with it. Buffalo says I would just say keep IMST as a paper trade. Yeah, that works too. Dude Face, you have a bias towards guys named Jeff, Park, Walton, and Booth. I know. Perhaps if a Jeff speaks, we should all listen. I'll ascribe to that. Yeah, you can't go wrong. Can't go wrong with a Jeff. Jeff Booth, I think he's going to be Jeff Prime. He's the original. Dude Face, China has said that they are doing QE, essentially devaluing their currency rather than submit to the tariff. They've got to been doing fucking QE already. Yeah, I just hope they keep fighting it out financially, because if you followed, Ray Dalio at all, I don't know that I necessarily trust that guy, but his view of the changing of the world order was a pretty good, made sense to me, pretty good video. Yeah, usually the debt system implodes and then a bunch of people have to die, and then whoever wins the war starts at the top and then basically siphons money from the rest of the world until we get another reset. So hopefully they just QE each other to death, and Bitcoin saves us from World War III. You rock. So you, for real, keep up the good fight. I recommend listening to or watching some of the MIT Bitcoin Expo panels, a good mix of TradFi and paranoid crypto anarchists. All right, I bookmarked it, and I need to check it out. That's the one that our Jeff Walton was in, right, with Dylan. What's the net worth at these days? I mean, I guess it's not a secret. Like, you could add up all of these positions. I think it's sitting around 800K. Which is about a 3x from last March, but it's down 60% from November, which is painful as fuck. There's a saying that goes, if you win $1 million and lose $1 million, you lost $1 million, because that's what it feels like. You know, you make some money and then lose it. It doesn't feel like you're just back to where you started. It feels worse than back to where you started. All right, we are all caught up on the chats. Thanks everybody for tuning in.